All right, folks, we got a special recording today. We're going to go through three different um, daily emails for the second half of the week for Keith Fitzgerald, starting with Wednesday, July 17th. So let's jump right in. This one is different because it's not necessarily 5 points; it's more of a different flavor. So let's just go to it, read it, and then after that we will transition to the following few emails, and we will offer commentary in between regarding our thoughts on what Keith is thinking, because this is the most important thing, is to understand the wisdom of a guy who's been in the industry for 44 years and to be able to glean from that the absolute best of the best. No pun intended. All right, folks. So back on the 17th, there's everything and nothing that we haven't talked about already in excruciating detail happening this morning. Rather than rehash that and bore you to tears, let's get down to business. Chaos always creates opportunity. So here's my playbook. Number one, rotation is a myth. A quick look at the headlines and I see rotation screaming from one side of the internet to the other. Don't fall for it. Rotation implies that the markets are a zero-sum game because investors must move money from one sector to another. If money comes out of tech, it must therefore go into value or dividends or bonds or something else, according to pundits, pontificators, and posers, then back again. That's not how the game is played. Okay. The markets continually create new profits and as prices rise and fall. That's why over time, long-term investing gains tend to overshadow short-term trading results. Big dips and sell-offs bring more stable, less active money into the markets in search of new opportunity every time. The world's most successful investors don't have directional risk the way you'd think because they A, focus on quality names, B, control risk as part of the buying process over longer term horizons, and C, continually play offense even if they must think defensively to do it. If that sounds familiar, it should. I encourage you to do the same dang thing constantly. Moreover, I share my thoughts with anybody who's interested on TV right here, and for those who want more, including on how, when, and why that can help take things to the next level in one bar ahead. So he'd love to welcome you on board if that's helpful. So number two, mind over matter. If you don't mind, big sell-offs don't matter. When in doubt, zoom out. Number three, think like a wolf, not a sheep. I often tell investors to pay very careful attention to what Wall Street does, not what it says. For example, small caps have been all the rage in recent weeks as Wall Streeters talk up the need to broaden markets as interest rate cuts loom. Right on cue, small caps took off in an epic 5-day run, the fifth since 1979. Investors are positively giddy that the Russell 2000 is up 12.8% or triple the S&P 500 over the past month. Yeah. Watch this video from Jim Crim explaining the basics of stock market manipulation. Now ask yourself three questions. What do you think is really happening? Who do you think has their wallet in the game? Who do you think is buying today? Wall Street's biggest players are known to go to extreme lengths to convince you the sky is falling when they're buying, and that prices will go to the moon while they are selling. This is a 1 week move into small caps. 1 week. On the other hand, and to my earlier point, Nvidia has returned 2,939.14% over the past 5 years, while the S&P has tacked on 103.21% over the same time frame. IWM, a popular ETF proxy for the small cap Russell, has returned 54.38% over the past 5 years. You can do the math just as easy as I can. Keith's investing tip: beating Wall Street at their own game isn't particularly difficult over time, but you must learn to think like a wolf, not like the unsuspecting sheep who get lured in by the headlines. Then use simple, effective tactics that take away Wall Street's advantage by making you harder to separate from your money. Number four, the markets are constantly making new highs. Most aspiring market mavericks have an uncanny knack for doing exactly the wrong thing at precisely the worst possible moment, meaning they buy or sell at times that inflict the greatest amount of financial damage on themselves. Not surprisingly, many of them get all bent out of shape whenever there's a concerned round of selling. Here's the thing. The markets are constantly making new highs. That's how they work. Moreover, there is a very powerful upside bias over time because of the constantly growing amount of money chasing fewer and fewer quality companies. Let that sink in. The S&P 500 has spent 83% of the time at or within 10% of all new time highs since 1927. What's more, it's achieved roughly one new high a month, so 1,300 new highs over the past century. Learning to face down fear makes you an unstoppable investor. Don't get me wrong. I know it's not easy, and I will never pretend that's the case, but it's important you try and that you take the data I share with you to heart. You got this. Number five, scared money never makes money. Wall Street has spent millions learning how to push your buttons and play to your emotions. It's not personal, it's their job. Keep your emotions out of the equation and days like this. With a ton of red on the screen, you won't bother you much, if at all. Look at all the blue and smile. S&P 500 over time. Bottom line, investing in optimism beats cowering and pessimism any day of the week. Now, if you'll excuse me, I've got a few stocks I'd like to snap up and some money I'd like to put to work. And yes, in many of the great names we talk about frequently, starting with tech. As always, make it a great day. You got this, I promise. Keith. Okay, so that was interesting. That was an interesting first email to cover today. So it was a little bit different, but nothing that is not necessarily um, unfamiliar. Rotation is a myth. He debunks that here, saying that the money needs to be deployed. So controlling risk, focus on quality names, and playing offense as opposed to rotating. Small caps is a joke for those that are aware. Don't be lured in. And markets are constantly making new highs, right? And then scared money never makes money. So this is something that's consistent with Keith and powerful to note. Now let us go to Thursday, the 18th of July, and see what this email brings for all of us who care about Keith Fitzgerald's wisdom. Okay, here we go. Good morning. My grandfather had a sign mounted to the inside of his office door frame so that it was the last thing people would see as they left, and I find myself thinking about it at 2:30 in the morning as I type. There are three kinds of people in the world: those who make things happen, those who watch things happen, those who wonder what the heck just happened. Which one are you? Most folks have no idea, which explains a lot about the world we live in days like yesterday. Futures are naturally trying to make a comeback, as I write, after what CNBC is billing as the worst day since 2022. Make no bones about it, the reason headlines play like this is because fear always has a platform. Put that aside. Investors don't fail because they have bad days. No. They fail because they lack a proven long-term framework and the perspective needed to get past short-term market noise. Tape this picture to your monitor or forward if you prefer. When in doubt, zoom out. Days, years, decades. Here's my playbook. The smackdown is an incredible buying opportunity. We are likely to have a historic earnings season, especially for big tech and especially when it comes to AI, even if there is more selling. I keep a buy list handy for just such occasions. Hopefully you do too. My point of view, the markets are the only store on earth where people fear a sale. The question, per my grandfather's sign, is whether there's more selling ahead, but rather what you will do about it and how you will address the opportunity it creates. TSM, buy, sell, or hold. Taiwan Semiconductor shares have returned 65.58% this year, even after all the selling yesterday. The S&P 500 has turned in 25.70 by comparison this year. Demand is off the charts. TSMC products are found in everything from AI to smartphones. 62% global foundry market share, up from 59% year on year. CEO CC Wei said, demand is so high I have to work very hard to meet customer demand. Should you buy TSM? It's a great company in many ways, but before you do, consider this. I prefer another two chip makers because they've gotten even better upside. You can learn more here if you'd like. Keith's investing tip. People often split hairs, which is a particularly popular undertaking with the yeah but crowd when it comes to stocks like TSM. My point of view is far simpler. AI is going to be the single largest investing opportunity in recorded human history. So what if there's a pullback, a correction, or a drawdown, whatever you want to call it? Be in it to win or you won't win. Number 3, Lagarde pulled a Powell. ECB central bankers have totally, sort of, maybe just possibly kept the door open for September cuts if reports are to be believed. Not that I'm skeptical or anything, but right. Central banks, including our Fed, will say anything to perpetuate the illusion. The better choice is to ignore them and to focus on companies putting up real results anyway, no matter what the ECB or other banks do. It's a very short list. Christine Lagarde did exactly what Uncle Powell is doing. She punted. Keith's investing trip. Rates are for traders. Profits are for investors. An impressive dividend choice for income-oriented investors. People often go to the highest dividend yield, particularly if they're income-oriented. True shareholder yield, which I use to help guide the one bar ahead investing approach, is a better metric. Take Gilead Science, for example. The listed dividend is 4.15%, but the true shareholder yield is 5.28%, and at these prices, I submit one hell of a bargain, especially if you understand how to buy the dang stock. The right tactics can be a huge advantage. Number 5, what the Mirage closure tells me. I've been to Las Vegas more times than I can count over the years. Funny thing is, I don't gamble. But I do take in the sights, often running on the strip in the early morning hours ahead of speaking engagements or just rolling off an airplane in the middle of the night following a long international flight. The Mirage volcano was always a sign that I'd arrived. Now it's going to be replaced with a nearly 700-foot tall guitar-shaped hotel according to Hard Rock International, which owns the joint. People constantly hunt for technical or fundamental indicators when investing, but sometimes the best signs of all come from what you see with your own eyes. In this case, more large-scale development. Vegas isn't built on the cheap, so this tells me there's still plenty of cash available, plenty of risk willing to be taken, and lots of opportunity ahead. Vegas is a microcosm of the broader economy, albeit one that's considerably stronger than the data would seem to suggest. Bottom line, when in doubt, when the winds of doubt blow, go to the strongest names. Make it a great day. Okay. So now we're gonna go finally to yeah, Taiwan Semiconductor. This is the only thing I would not for this email. This would be the only one I don't agree. I think Taiwan Semiconductor is worth it. I do think that they're it's almost like non-buyers or more. So I think that, for example, me having some is better than not having some. Of course, it's not nearly as proportionate to to an Nvidia, but you also want to have the upside too. So if the upside is not as big as Nvidia, then it's the fact that I just didn't put all of my eggs in one basket. But TSM has still been up. So whether it's up by 50% versus 60%, you're still happy if it's up. Okay, now finally, let's finish this video with the 19th of July, which is Friday, and let's just jump right in. Okay, so good morning. The markets are a mess, working normally. If everything else, that's apparently a disaster on the heels of a cascading global IT outage caused by a CrowdStrike software upgrade pushed into systems worldwide, flights, medical records, trains, and more. It's one of the largest IT blackouts in history, and it'll be a rearview mirror shortly. Here's my playbook. The CrowdStrike situation is only tough for those who haven't got game. Chill. And if you'd like some help getting your game on, I'll be here. OBAers will have a special update shortly. By the way, if you consider yourself a trader and you're not all over this, you need to take a hard look in the mirror. Just saying, personally, I'm grinning ear to ear. Number 2, SunPower's toast. Tax credits are not a business strategy. Not that this is a surprise. I've repeatedly encouraged investors to avoid stocks like this one that are often built on nothing more than hopium, clickbait, and Wall Street fancy. You can make the argument for bottom fishermen, and some are, but that's a fool's errand. High rates, too much inventory, and super high installation money just aren't a good mix at any price. Shares are down almost 90% and likely on their way to $0. All right. I feel very sorry for the dealers who got sucked in. Many are mom and pop shops. Keys investing tip: if customers aren't running to a company's products before the government gets involved, they're sure as heck going to be running away shortly afterwards. Buy the best, ignore the rest. Okay, well said. Netflix wants investors to be more business-centric. That's rich. The company is phasing out subscriber metrics, including membership numbers and average revenue per user, both of which are legacy, makey, uppy Silicon Valley specials left over from the go era when there weren't real business results to focus on. So they cooked up both of the metrics as a way of distracting everyone. Still, nice job. Revenue is up 70% year on year, and advertising supported memberships grew 34%. My point of view, streaming services are going to be in exactly the same position as cable TV shortly. Customers will ultimately leave because they don't like getting carpet bombed by advertising. The only reason we still have Netflix in our house is because it's provided via our T-Mobile plan. And they hate the fact that it takes several minutes to load now because of all the BS getting shoved onto our box in the name of personalization. Shorting streaming stocks is tough because Wall Street has a vested interest in defending them for now. Prime did the time. A new record, $14.2 billion spent Tuesday and Wednesday for the Prime Day. That's an 11% increase according to Adobe Analytics, which tracks this sort of stuff, and CNBC, which is reporting it. I still won't touch Amazon because I think there are bigger, better bets for my money. Stuff with actual upside, not legislative and regulatory headwinds. But that's just me. Amazon has returned 38.33% over the past 12 months. Nice. It's made a lot of folks a lot of money. Okay, number 5. A disconnect in the C-suite. I place a premium on investing in companies where the CEO dishes up results, not excuses. That's why I could only shake my head as I watched the interview with Charles Schwab CEO Walt Bettinger, who defended his company, saying that customers and investors are confused after shares tanked following crappy earnings. Contrast with JP Morgan CEO Jamie Dimon, who leads from the front, speaks bluntly, and who takes responsibility for everything that happens on his watch. He is always sharply focused on the future. JP Morgan shares have returned 40.4% over the past 12 months. Schwab shares are down 5.11% over the past 12 months. You get the idea. Bottom line, people fear losing money in the markets, which is normal but completely misguided. What that you really fear is not making more. Make it a great day as always. You got this, Keith. Okay, so With that being said, that covers 3 days of emails, and for this most recent email, I agree with the C-suite stuff. This is the one thing that Keith does very well is his sort of business acumen, not just from trading, but the actual leadership of companies, which is why both Keith and I are focused on listed companies, because there's just, we could go on and on about why good leadership results in value creation and why stocks naturally go up with good leadership. And it's measurable and it's tangible. And then, yes, Keith's made a good point about Netflix. Keith's made a good point about SunPower and government credits and government subsidies. And then Keith made the first point about CrowdStrike that, yeah, the stock was down nearly 12, 13%, but what he's saying is that the stock will rebound very, very soon. So you want to buy on that dip because it'll bounce back. So ideally, if it goes back to normal, if it's down 10%, it'll be up 20% if it were to return to before what just happened. Okay, leave it there for now. Have a nice day, everybody. More 5 with Fitz reviews coming in the future.